Well, good morning, everybody, and welcome to the introductory session for the Tarsus Academy High Expectancy Price Action Trading Program. For those of you who have been on any courses with me before or have heard me lecture before, I think you will understand what this means, but for those who haven't, just a brief discussion as to what the title of this course is saying. First of all, the trading approach that we adopt in how we manage other people's money is based on appreciating that we are dealing with an environment where uncertainty is prevalent. Within that, the question then becomes, how on earth do we create a high expectancy in our trading activities? How do we even have a positive expectancy if that is true? There are two approaches to this. The one is predictive, which unfortunately generally ends up in disaster. The other is non-predictive. It is in this that people like Nassim Taleb have spoken about the reality that convexity, as he puts it, is much more important than understanding. This course unpacks what that means. How do we operate in an environment that is effectively characterized by randomness, meaning that we cannot know what is going to happen in the future? The second aspect of the course is that the analysis techniques that we use are price action based. A lot of people will classify this within the technical analysis field. We beg to differ on that. However, at best it is a subset of technical analysis, but by definition technical analysis being an area which is indicator-based analysis, we do not use that at all. So hopefully, as a brief introduction, that serves to explain the meaning of the title of the course. The rest of today will be introductory. However, I hope that the following mindset sessions will also be useful to you, which we will cover during the course of today. And from there, we will move into technical analysis and looking at rule sets that give us this high expectancy. So I hope you enjoy the day. Thanks very much for watching. First of all, really important for me to say this, because everything we do, again, is based on this understanding. So many people come into trading with a false view of what it's all about. And much of today is really to try and unpack that and to reassemble your understanding correctly. So, what do I mean by reality check? Well, this is a zero-sum game. It is not a place where it's easy to make a fortune. Is it possible to make a fortune? Certainly. People have done that. People continue to do that all the time. I like to think myself and my partners on the way to doing that ourselves. So certainly it's possible to make a fortune. But is it easy, as it's been advertised just about everywhere you look? I think, compared to 10 years ago, the amount of advertising for brokers and trading education centers and so on is massive today. I can't believe it. You see it on football fields around the world. It really is a big marketing drive to pull people into the market. And one of the number one messages they put across is that it's possible to quite easily make a fortune out of trading, and especially trading currencies. Now, that's just not true. Whether we like it or not, this is a zero-sum game. If you make money in the long term, somebody else has to be losing. And the fact of the matter is, it's not very balanced. It's not like 50-50 either, which is what I'm going to illustrate here. I'm just going to look at a typical timeline. These numbers are average, but they're not completely, they're not unrealistic at all. They're pretty much average numbers. And also, it's a smooth progress through this. It's not, something that you see, every in segments of 180 days or 360 days. But first of all, let's say we have on day one, at any point in time, you've got 100 new traders coming into the market from various places. They might be doing what you're doing, going on a course. They might be checking it out on the internet, because there's tons of free material out there to learn how to trade. And some of it's actually quite useful. For those of you who are on my main program, you will have heard me guide you or seen me guide you towards babypips.com. When people first want to learn how to trade, they don't know what a pip is, and they don't know what a candle is. They don't know the different types of broker. That's really the place where you can go and get that information, and we don't have to spend time here talking about that. So Certainly, I think those of you who've been chatting to me about doing this program over the last month, I think you've done that already. So let's say we get our 100 starting traders. And by the way, this also includes people coming into an institutional environment, which is where I grew up, if you like, in inverted commas. So this is not just retail traders. This is across the board, including in the banks and the funds who recruit junior traders, which not all of them do, but those who do. And let's say each of those traders has on average $10,000. Again, an assumption. So the total capital being brought into the market is $1 million. But on day day 0, I suppose, more correct, T0, nobody's done any trading, so no one's either lost or made any money. A year later, we're probably down to about 20. 80 of them are gone. Those 80 have lost their $10,000. Again, I'm making a few assumptions here, but this is not entirely inaccurate. So if those 80 have lost their $10,000, it means total losses now made in the market is $800,000. Where do you think that's gone? Well, it's gone to the other 20 surviving traders. Not necessarily evenly, and not necessarily all at the same time, of course. It would have happened progressively over time. So like day 180, maybe we had 50 traders still surviving. And the evenness of who holds that money, obviously, it wouldn't be entirely even. But nevertheless, this is fairly typical. Now we've got 20 traders here who overall are actually successful. And not just at a small level either. In fact, they have reached the dream that everybody's talking about. They've each, on average, have got $40,000. Some less, certainly. Some might still be sitting in a loss situation. But on average, the average trader here has got $40,000 after a year, which is 300% return. That's not bad. That kind of meets the expectations. Some people talk about 100%, but a month or 20% a month, which give you 100% a quarter. Nevertheless, 300% in a year is pretty spectacular. They are on their way to reaching that dream. But there's a problem. After 3 years, we're probably down to about 2 traders. So total losses in the market now is $980,000, which means that $1 million is divided between 2 people. What about the other 18? I mean, these guys, on average, had $40,000 each. They were, on their way to making a fortune. What happened to them? Well, the fact of the matter is there's actually a significant difference between the first 50 to 80 traders who fell off the wagon in the first year to the last 18 who died before day 1080. And what we're going to be talking about today is kind of going to show you where these people fall in. Now, it's not massively important for me to explain that in detail now, as long as you appreciate that this is what actually happens. This is what happens, and I'm sure you've heard it. You've heard both sides of the story. You've heard that it's possible to make several 100% a year in profit, but only a couple of percent of people who try trading survive. How do you put those two numbers together? Well, this is how you put them together. They're both true. But one of the most important things to learn in trading is that you can make lots of money but lose it all in one day. I have seen this happen multiple times, even in just the last 10 years. But before that, at an institutional level, we have seen this happen over and over again. And I mean, when I was still working in London in 1998, probably one of the biggest market events that I have witnessed, there's probably 4 or 5, it definitely is in that list of 4 or 5 massive market events, was the failure of long-term capital management. Probably one of the most successful hedge funds in history, run by 2 Nobel Prize winners, people who were, masters of the universe, were making spectacular returns year after year after year. They went bankrupt in the space of a few hours and almost brought down, certainly the US financial system. The American government had to, that's when it kind of started. They had to bail them out. So that should be pretty scary. It should scare you. That's kind of my objective here, because without having a very healthy respect for what you're engaging with, you're likely to end up being, one of the 98. And unfortunately, because you're on a good course, what's even more unfortunate is that you're more likely to be one of the 18 rather than one of the first 80. And you might note that the 18 lose much more money than the first 80 people lose. In fact, if you're going to fail at trading, rather be one of the first 80, okay? Because you're only going to lose a little bit. So the way I normally express this is, well, in a couple of different ways. And it's not to try and put you off my course or anything. It's because this is, being brutally honest, is very, very important. But one of the things that I like to say, I'm actually echoing another very, very good trader, somebody who retired, an exceptionally wealthy man. There's always somebody else out there making more money than me. Always. I'm never, at any point in time, I'm never the most profitable trader. And of course, that's the sort of thing which, might make you think, well, perhaps I need to go and talk to somebody else, one of these other guys who's making more money than you, to teach me how to trade. Well, okay, welcome to do that. But listen to what I'm saying carefully. At any point in time, there's always somebody else making more money than me in trading. I am never the most profitable trader at any point in time. But you know what the strange thing is? Every few months, it's somebody different. The faces keep changing. And this is what I'm talking about. Those people who fall into the last 18 people generally are the most profitable whilst they are still trading. But their problem is they never get to keep the money. And this is the biggest challenge in trading. I promise you, to learn how to be profitable in trading is not the biggest problem. To make money is not the biggest problem. Keeping it is the biggest problem. And ideally, what I would like to have is people who come on my training at the end of the day, not only pick up all the technical skills and everything else, they actually learn enough about the underlying concepts of how the market works and the real dangers involved, the real risks, many of which are hidden, by the way, the real risks in engaging in the market. And at the end of the day, you not only make money, but you get to keep it. So I'm not going to be talking about spectacular returns here of 20% a month and so on. It's certainly possible using my trading approach and style, but you'll see it comes with a cost. The reality is that the best institutional traders in the world today, in US dollar terms, are making about 20% a year. Now we actually do better than that in our fund. We have some advantages. Well, we don't yet have the disadvantage of having several $1 billion under management. It becomes more difficult across multiple markets to trade. But even so, it's worth being aware that a good target is probably 50% a year if it's your own money. You can push it up to 100% a year, certainly. It is doable. The turtle traders in the 1980s definitely did that. But again, that comes with a cost, as you will see. And each person needs to evaluate their appetite for risk before they decide what kind of return they would like to have. We're going to talk about that in a lot more detail. All right, so that's really an important introductory statement. As I say, it's a reality check. It also just lays the groundwork and sets the expectations for everything else we're going to do. Bear in mind that something that we're always trying to do is make more money without taking more risk, which then allows us to actually make the same money for less risk, whichever way you want to go. That is the challenge of a professional trader, is finding ways to do that. And really has been part of my if you want to call it life's work, if you like, for the last 10 years, is working on that, principally on that. So the point being, overall, trading is not a sprint, it's a marathon. You want to finish the race. The turtle traders were well named. You might even want to call yourself a tortoise trader, with the whole tortoise and the hare thing. That definitely is very true for trading, where ultimately you've got to get to the finish line. And that finish line is the day you decide to retire from trading. So it's a long way ahead. So having laid that's my soapbox moment, for the first one anyway. Having laid the expectations there, and hopefully given you an understanding of what you need to be watching out for, let's talk about the conceptual overview of this entire program. There are a few things that really puzzled me when I moved from being in an institutional world to being an independent trader. Because in the institutional world, you've got all sorts of checks and balances, and you've got quite a narrow focus. And ultimately, it's definitely not your money. So it's very, very different. When you go out on your own, and when you're trading a significant portion of your own personal capital, things change dramatically. And when I first went out on my own, which is now pretty much 10 years ago, the one thing that I wanted to know was, what are the attributes of a good trader? Well, what makes a good trader? How would we define a good trader? Who is that person? Point him out to me. I want to understand what he looks like, and what it is that he has that makes him a good trader. And I couldn't find that anywhere. However, what I was able to do was find out who was actually successful as a trader. And again, coming back to what we've just been talking about, somebody who had retired, or else maybe was still in the business, but had been in the business for more than a decade. So had weathered many of the big market events. What I also found out is there were some people that, in fact, had made most of their money in cataclysmic market events, such as, obviously, 2008, long-term capital management. I mean, those billions of dollars had to go somewhere. The dot-com bubble popping in 2000. I was there. I was in the UK. I was head of an institutional portfolio, including the Wellcome Trust assets, which was $24 billion at the time. And we watched those $24 billion go down to 18 in the space of a few months. Where does that money go? Now, obviously, there's some unraveling of debt and things like that, but certainly there is a flow of capital from one group of people to another. Same thing with 2008, much more recently, where the S&P 500 lost 50% of its value, again, in a few months. The MSCI World Index lost 57% of its value. I mean, it's crazy. In a few months, the top 2,000 stocks in the world lost more than half of their value in the space of a few months in 2008. In fact, a story that I often tell, and it's not a story, this is the truth. In 2000, when we had the dot-com bubble popping, I mean, that's when all the masters of the universe were saying, no, things are different now. The world has changed. The economic cycle is not what it used to be. We're not going to have a dip in the future, etc. All the usual stuff that comes out when there's a bubble. Anyone, and I was involved in managing assets which were principally institutional funds, which includes pension funds. And your typical pensioner, or somebody who's working and approaching retirement, generally has a time, or is advised at some point in time, to start moving their assets from growth assets, such as equities, into fixed income securities. Now, normally that's done over a sort of a staged period where you would gradually start changing the balance in your assets from growth equities, growth assets into fixed income. Because the growth in that market had been so strong, equities were doing phenomenally well. Most people were actually delaying. People who should have moved their assets from equities into fixed income had delayed doing that. Unfortunately, and literally, when the dot-com bubble popped in late 2000, these people were all caught with their pants down. And the consequence of that is that many people who retired in the following couple of years, who wanted to retire in the following couple of years, today, and I mean now, 2017, 17 years later, almost 17, 16 and a half years later, are either still working or they're dead. Now that should scare the crap out of people. And a lot of what we do in our trading as well is about managing that risk, about understanding that that's the sort of thing that can happen. And more importantly, recognizing that that money goes somewhere. And good traders are generally the people who are standing there waiting with their buckets like when it starts raining, for when that moment comes, not knowing specifically. It's like a farmer in the Free State. They don't know when the rain's coming, but when it comes, boy oh boy, they're waiting there with their buckets. And really good traders often do that. Paul Mulvaney, who heads up Mulvaney Capital, in 2008, he's famous for making over 100% return for his clients in 2008. That's 2008. Now, the reason why in 2017, maybe some funds are back to above where they were before, but if you took $10,000 of investment back in 2000, and you take into account the crash of 2000, or the bubble popping, as well as the crash of 2008, despite all the growth that's taken place in between, if you add in fund manager fees, then your typical investor would not be significantly in profit today. So when people say, the stock market gives an average of 8% return per year, that's all well and good, but that's an average over the long term. And we don't live with averages. We're born, we work, we retire, we die. And what happens in that fixed span of time can be very different from the average. Taleb is famous for saying things like, if you want to cross a river that's on average 4 feet deep, and assuming you can't swim, you will drown. If an adult wants to cross a river that's on average 4 feet deep and you can't swim, you will drown, because on average it's 4 feet deep. In some places a few inches deep, which means that in the middle it's a lot more than 4 feet deep. And it's the same thing with our trading. It's the same thing with our equity curve. It's the same thing, that understanding that, yes, the market does come back eventually. If you're in a trade, yes, it does. But as John Maynard Keynes, one of the founding fathers of neoclassical economics, said, the markets can stay irrational a lot longer than you can stay solvent. So these concepts are all there, they're always there, and they need to be brought into our trading. And I'm just talking at a high level here. They need to be brought into our trading at a practical level. And that is one of the things that we're obviously very careful to do in everything that we do, as you will see. All right, so coming back to my question then, what makes a good trader? Well, that understanding is essential. Let me just make sure we get the next slide up. Right, the complete trader. Now, I talk about the good trader, the complete trader, sort of grandiose statement, but nevertheless, it's a great ideal to be working towards, to become a complete trader. Okay, so as I say, what are the attributes? Well, first of all, mindset, which I've been talking about now, is essential. But to back that up, we also need a real skill set and finally a rule set. These three attributes are kind of it. I've yet to find something else that's important that falls outside of these three attributes. Today's discussion is primarily around the mindset, but actually something more than that, because as you will see, there's something that overshadows all of this, and a kind of umbrella that covers all three of these. All three of these come from a bigger principle. But just to point out that as far as I'm concerned, if we don't deal with the mindset issues up front, if I don't make you aware of the mindset issues up front, then everything else is going to be a waste of time. Developing your skill set, which is, again, the sexy side of trading, will be a waste of time. And the rule set, which is pretty straightforward, also a waste of time. The irony is, when people come into trading, they normally start at the bottom. They want that rule set, a strategy that's going to make them all this money, and they go on the internet and what have you, spend lots of money on buying strategies from people who are purveyors of these dreams of easy money. And of course, on their own, they don't work. They cannot work. If you combine that with a good skill set, well, certainly you can get that to work. You can make money with rule set and skill set together alone. But it's these people that are generally of the 18. The ones who've got the rule set only are usually the first 80, as we saw earlier. Those who've got the skill set and the rule set but no developed trader's mindset are normally those who fall into the 18. And that's the group that you really don't want to be in. If you're not going to make it in trading, rather fail fast. In fact, just about everything in life, I think it's best to fail fast and go and try something else. The guys who get as far as developing a good skill set to back up their rule set don't generally fail fast, but they do almost inevitably fail. Unless, of course, they get to understand that you need to have an enveloping mindset, a robust trader's mindset as we call it, that covers everything else. So normally that's the route. They start at the bottom and you work your way up. In fact, that was the route for me. So again, what I wish I knew when I started was that you've got to start with the mindset, at least developing a general understanding of what it is that we're actually engaging with here when we're trading, what it is that we're actually doing, and based on that understanding, know what we then need to do, as you will see. Okay, so that would be then the initial discussion to lay the groundwork for the rest of what we're going to be talking about today. And after this, I'll be getting into a bit more detail about these attributes that make up the complete trader.